Welcome to the NWR Resources Virtual Resources Series. My name is Kerry Stevenson. Next up, we have a keynote address from Guy Keller. He is a portfolio manager for the Tribeca Nuclear Opportunities Fund. Now, Guy has had over 20 years of global commodity trading experience. He's worked in London, Singapore, and Sydney. He spent the last 15 years as a director with Macquarie, and he was most recently in Singapore as head of the Asia Base Metals Trading Desk. He's run strategies across base metals, precious metals, and iron ore. He's got an extensive network of industry contacts. So I'm really excited to hear what he's got to say today about why they've set up the fund and all about the uranium space. And I guess in a decarbonized world, why it is going to be important. Guy, great to see you. Thanks for joining us today at this NWR series. Looking forward to this presentation. Over to you.
Thanks, Kerry. Thanks for having me, and thanks for NWR for the opportunity. So yeah, I'm here to talk about the nuclear sector and why we as asset managers got involved in the sector. As Kerry said, I work for Tribeca Investment Partners. We have traditionally run a global natural resources business. So we as a company, we're asset managers. We have some wealth advisory and some corporate advisory. So I'm part of the global natural resources business. That's been in existence for about 7 or 8 years now. The people that are part of my team here, we all come from either commodity or resource equity or resource mining backgrounds. So we're mining specialists. When we started looking at uranium as part of our batting order, which I'll touch on in a few slides' time, we identified that. So my job within global natural resources was to look top down, look at the fundamentals, look at the positioning, and look at the reasons whether a market was under or overpriced. When it came to uranium, it flagged as almost something wrong with my process, because it was flagging that disjointed. So I sort of ran the numbers again and sort of realized that there was nothing wrong with the process, that it was obviously something wrong with the market. We looked a little bit more deeply. There was a lot of reasons as to why the market was justifying a $20 uranium price and in a 10-year bear market. But for us, it didn't make a lot of sense. I'd been in commodity physical markets where, for example, there was lots of inventory overhang and plenty of people telling me that was a reason why the price would not go up, which is one of the reasons why people were looking at uranium as going nowhere. But as we're finding out now, uranium is only as mobile as the people who hold its willingness to part with it. The reason we spun out the nuclear fund was that once we started getting an investment thesis towards the sector, I think we took 3 positions 4 years ago, 2 of them here in Australia, and then the London listed Yellowcake. We very quickly became very substantial shareholders of those companies and realized that that was probably going to be the case for everything we looked at, because the sector was so small. So we rolled out the nuclear strategy, and we rolled that out about 4 years ago. So the strategy, like our global natural resources business, we're active managers, we're mining specialists. We tend to try to be a fairly concentrated portfolio in the uranium space. That's a little bit harder because it's such a small investable universe. I mean, to put this into perspective, and we'll touch on this when we talk about decarbonization later, to put this in perspective, the global investable market cap of the uranium mining sector is about $35 to $40 billion. So it basically sits inside of Fortescue. Yet,
goodness gracious.
I know, and it produces the raw material input to power 10% of the world's electricity. So it's an amazing disconnect when you look at that. And so, as I said, we've probably got 20 positions in a universe that's not actually that much bigger than that. So this is sort of how we set ourselves up. One of the 2 big themes that we have been banging the table about recently in our global natural resources business is decarbonisation and electrification. And the reality is you cannot decarbonise the world without commodities to make that technology that will allow that to happen. And you cannot power electrification in a decarbonized way without nuclear. You know, we're in the middle of one of the biggest energy crises since the 1970s. And whilst global government representatives are practicing their decarbonisation speeches for the COP26 conference coming up in Glasgow, we're burning more coal than we ever have.
Isn't it extraordinary, Guy, that that's exactly what's happening? We are burning more coal while everyone's talking about, you know, fossil free and all the rest of it, but it's because they can't switch from one to the other like that. But people expect that there's a disconnect, isn't there?
Exactly right, Kerry. And this is where we look at the batting order in the world as to what resources do you need to decarbonise and to electrify. And, you know, it's no surprise here when we look at our batting order from a top-down perspective for the universe, it's no surprise that in the top right-hand corner are the commodities that you need to decarbonise and electrify. You need your copper, your nickel, your cobalt, your aluminium for your electrification of vehicles. You need your lithium, you know, and of course, to power those vehicles in a green way, you need low carbon electricity. And, you know, the reality is the only technology that currently is available to replace coal-fired power and gas is for base load electricity. So something that is generating electricity 24/7, not weather dependent when the sun's shining, when the wind's blowing, but to replace that base load, the only thing you've got is nuclear. So therefore uranium sits very high up in that batting order for us. When, you know, we mentioned COP26, and, you know, you're getting government policy decisions everywhere around decarbonisation, and everybody's putting a timeline on that. When ironically, when you look at the ones we picked out here, China, United Kingdom, France, United States and Canada, guess what? They all have nuclear power. EU, ooh, not so much unless they're getting France's surplus nuclear power. And, you know, when you look at that decarbonisation, the top left here, nuclear energy has one of the lowest carbon dioxide emissions out of all the power sources. When you look at that top part of that chart, it's accompanied by wind and solar, which are weather dependent, not baseload. Hydro is not far behind that. However, that requires a geographical land formation that allows you to dam a river that flows water and dam that river in such a way that you're not affecting whatever country is downstream of you. Or in the case of China, relocating, you know, 5 gorges worth of people. Yeah. So it doesn't work for everybody. And it's once it's built, that capacity is the capacity. You have to go and find another one to go and replace that. So, you know, it's sitting there. And when you look at then the reliability in the United States, nuclear power generates electricity, it's got a capacity factor. So it generates electricity 92.5% of the time, which effectively means for 335 days of the year, it's running 24/7. And again, compare that to the weather dependency that we're trying to replace hydrocarbons with, wind and solar. You're down at, you know, 25 to 35% of the time. So it makes sense. And I'd be flabbergasted if there's not at least sideline conversations going on at COP26 as to, you know, how do we get more nuclear to solve this problem? Because as we've seen, trying to replace coal with wind and rely on gas from the Great Russian state is not necessarily a strategy that's going to help you going forward if they want to play games with that supply. So when we touch here on the supply and demand, and this is a chart I love. This is from the World Nuclear Association's 2019 report. There's a 2021 report. I haven't had a chance to update this slide yet, but it's relatively similar. And the great thing about this chart is when you look at sort of 2025, 26 onwards, you see all that sort of light blue up the top, the purple, the green, and the red. The lower scenario is a scenario which I believe is now not happening, because the lower scenario in 2019 assumed that France was a negative demand growth, that the United States with a negative demand growth, and that Japan would remain neutral. As we've seen recently, the United States, with state legislature in Illinois and federal support from the Biden administration, we see the United States now as neutral demand growth, which means the reactor retirements that had been factored into this model are no longer going ahead. They've been extended. France now, with the 32 900 megawatt reactors finally getting their 10-year life extension. That was announced a few years ago. It was approved earlier this year. That's 32 out of 56, I think, reactors they running for another 10 years, from 40 to 50 years. Now, bear in mind, the United States has been approving reactor life extensions from 40 to 60 years and also to 80 years. So there's a chance that France do that again. And we're also weeks away from the French government announcing whether they'll go ahead with 6 massive reactor builds to start soon. So you've now got a demand scenario. Oh, and of course, Japan's now coming up to COP26. They've seen record high LNG prices, gas prices. They've seen record high thermal coal prices. They are an energy importer. They're sitting there with 30 plus reactors idled as a result of Fukushima, all going through lengthy bureaucratic safety requirements around anti-terror and things like this. The government now, the rhetoric's changed. They want these reactors to restart because it's costing them a huge amount of money with the other energy inputs at this level. So I look at that now and say the lower scenario is somewhere around the reference scenario now. And as I said, those coloured little bars there are fantastic, because the WNA assumes that every care and maintenance mine and every mine that's under development, so it's got a feasibility study around it and a mine plan of some description, and the planned mines, they're all going to come to market. Now, as a resource investor in the mining sector, we know sometimes from painful experience that what it says on the box isn't necessarily what happens. And so, if there's an assumption that all of these mines, I think in 2007, in the bull market, first real proper bull market of the uranium sector in the last 30 years, I think analysts were calling for 29 uranium projects to come to market. So remember, we were having a price that moved from $10 to $130 over that period. 7 came to market out of 29.
Wow.
And that was not even, there was not even that was still 7 that came to market. That, the other balance wasn't Fukushima that stopped them coming to market. It was a whole bunch of other reasons. So I love that chart because it screams to me deficit, 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 whichever way I splice and dice it. And when I look at the upper scenario, which doesn't even include small modular reactors, which is a technology coming, that France have now put €1 billion towards, that I think there's a dozen countries now chasing in the race to bring small modular reactors technology to the market. US is indicating 2026 connected to grid. China's probably there or thereabouts. Russia's already done a floating version. This scenario doesn't even include the demand for that either. So, and whether you say it's less uranium per output of electricity, it's still uranium.
Yeah.
Price. We've seen bull markets in the past. We know what the uranium price can do. We've been in a 10-year bear market where we've had massive underinvestment. We've had a broken mechanism called the spot market that everybody seems to want to focus on. And I have to admit, before August, before the Sprott Physical Uranium Trust came into existence, my response to anybody asking me about the Sprott price,
Sprott
was to ignore it, because like the iron ore market 10 or 15 years ago, nobody really cared about the iron ore spot price because it was all about the long-term price that BHP and the majors set. And so it was around the spread on that price that some juniors might have been getting for grade differentials. And if something traded in the spot market that was out of whack, everyone ignored it. The uranium market is exactly the same as the iron ore market used to be, except we don't have thousands of steel mills falling all over themselves to secure cargoes. We've got a concentrated number of utilities where the uranium input is not necessarily important to them, because US utilities might be 20% of their fleet is nuclear. And when the board looks at the cost of the uranium to run that, it's bugger all. I mean, it's 9% or something of their operating costs compared to gas, which is 80 or 90%, and coal that's not much lower than that. So if you're a utility now looking at gas and coal prices, where you're much more you're much more reactor gate, so you've got stockpiles that are as big as the storage that you've got, and it's a fairly easy market to get a shipment of coal in or gas. So you're a bit more short term. Nuclear, it takes you 2 years to mine mouth to reactor gate. So, but they're not worried about it because they haven't had to be. Sprott has changed things, and as you can see here, you can see that since they started in mid-August, the price was languishing around $30. We pushed up to $51, and had my bet back in July been that I would shave my beard when the spot price hit $40 or $50, I'd be clean shaven. But it was a New South Wales would be freed bet instead. But you can see here they've accumulated 14 million pounds of uranium. So since
sorry, Guy, to interrupt you, but what was the downward pressure there when it hit that high of 51, and then shortly thereafter came, well, not that shortly thereafter, but it was coming back down, and now it's spiked up again. What do you put that down to?
Yeah, so it's a really good question. So the spot market, there are some producers that sell material into the spot market. When I say some, there's probably 3. So we did see some towards the end of September, one of the trade houses pricing some spot material that was coming from a producer. So obviously, their interest is to buy it as cheaply as possible. They moved that price down in order to do so, and Sprott stood aside. I mean, you also got to understand, it's not Sprott forcing the buying, it's investors buying Sprott shares at the at-the-market facility that then allows them to issue the shares. They have to spend the cash. So, of course, the market rolls over a little bit. Investors step back and say, what's happening? This went vertical. And then, of course, another cargo from for the end of the quarter came in from a producer who's very well known to be in the spot market. So again, there was a couple of million pounds that came in. But the interesting thing was that even with that price coming off, Sprott, I think of the first shipment, I don't know exactly how much, but let's say it was sort of 700,000 or 800,000 pounds. Sprott took 400,000 pounds of that immediately and continued to buy that whole way down. So you can see those, the bar charts moving up still, even, I mean, it was a little bit sideways, but they continued to move up as they continued to accumulate. And then, of course, guess what? The material that was in the market cleared because Sprott took almost 1.2 million pounds of it. And suddenly there was no more for sale. So what happens then? Investors say, well, hang on, where's this? We're back at a premium, a solid premium to NAV. I want to buy some Sprott. And off it goes again. So you can see it bounce back very quickly. There was also some talk that...
Sorry to interrupt you, Guy. We only got a couple of minutes left, and I don't want you to miss out on telling us more about Tribeca, of the fund as well. So...
Okay, yeah, sure. You're right. We have talked on. There's a lot you could talk about. So, I mean, these slides we can sort of gloss through. Nuclear
we can provide that to people afterwards as well.
Exactly right. I think we can move all the way through these. I mean, so what we do, we're mining specialists. We do have the ability to look across the whole nuclear sector, and at some stage, we will certainly embrace nuclear technologies. The bits in the middle are sort of state-owned with fuel fabrication stuff that's hard. So we focus on the miners. We basically apply exactly the same strategy as we do for our global natural resources business. With uranium, jurisdiction, permitting and community are even more important because it's uranium. There's a whole bunch of people who don't like it for whatever reason. And so we certainly focus on that. We have the access to the market. Remember, we sat here for 2 years with everyone thinking we were crazy. where basically the only institution talking to these mining CEOs was ourselves. So we've formed extremely good relationships across the sector, and so therefore I'd be surprised if there had not been a deal, or if there'd been a deal that I hadn't seen. We haven't played in all of them, obviously, but if we hadn't seen. You can see here our performance. I mean, it's been a good performance is probably an understatement. However, I still believe that this is a perfect example of being early to an unloved trade. You can see last year we did sort of 345% net of fees, and calendar year to date, which obviously includes some of that first 6 months of the fiscal year performance, we're at about 170% net of fees. So when you compare the blunt instruments of the ETFs, we've outperformed them because we're active managers. That's what we do. We're in the weeds. We're talking to people. We're participating.
I'm in.
And then
that's a phenomenal performance.
Yeah, and I think at one stage Paladin had us pipped, but we've managed to claw back from and get back ahead of them again. But I blame that on the small cap guys buying it for index inclusion last month. I think we could touch briefly on this, but again, it's basically saying we're not ETF like. There are some blunt instruments which alluded to the slide before. We're different. We're different because we're active. We're seeing deals with. There's a whole bunch of things coming to market the next 6 months that we're already in discussions with, and I look forward to being able to share those because remember there's been 2 bull markets. There was 500 listed opportunities 10, 15 years ago. There's now 40, and there's a whole bunch of projects that are rubbish, but there's a few diamonds out there that we're hoping to be able to get involved in. And then again, you can share that. So, I mean, that's where I'll leave that, I think, because as you said, we're sort of nudged that 20-minute mark. And
we're nudging, and I've got questions. Ladies and gentlemen, if you want to ask Guy a question directly, pop it in the Q&A panel at the bottom of your screen, and I promise I will get that question to Guy. First up, Guy, first question is, what are your thoughts on the ANU Energy Physical Fund that was announced yesterday?
Oh, look, that's phenomenal. I mean, that's another 12 million pounds out of the market. When you add in the $600 million available still in the Sprott at the market before they renew that again. I mean, you're looking at, I think, one of these slides up here, when you look at the total physical sequestered right now between Sput and Yellowcake, it's 40% of 2020 mine supply. When you add that Kazakh one and the remaining availability in Sput, you're getting up to about 60% of primary mine supply that's not available to utilities. And this is where the maths works. 125 million pounds mined, 185 million pounds of demand. Eventually something has to break. There's not that much inventory out there.
Guy, it felt like back in 08, 09 when we had that massive spike in the uranium price, it was almost like a dress rehearsal for what's coming next. Do you expect that sort of a price rise this time around, and do you think it will be more sustained given the decarbonisation of the world, the fact that we've had this supply-demand gap that is widening? Do you think that there might be a rise in that spot price that will be more sustained this time, second time around?
Yeah, look, I mean, September proved to us that when, sort of pump and dump mentality comes in, it's a pretty small door. So, I can't rule out where it's going to top out. However, I do believe long term it will be sustained. You have to remember in 2007, 2008, you had some mega projects coming to market. You had MacArthur River, Cigar Lake, you had the Kazakhs that ended up, flexing up to be 40% of the market.
Yeah.
You had a lot of that going on at the time. You don't have that this time around. When MacArthur River comes back on for Cameco, it'll be contracted. The Kazakhs will not be increasing till post 2023. And you've got, as I was saying, government rhetoric now. You Googled uranium and decarbonisation, and 3 years ago, it would have said missing uranium from your search. It's becoming part of everyday rhetoric in governments. And so I do believe that it will be a much more sustainable bull market because, to the earlier WNA slide, even with the planned and prospective mines that they know about, there's still not going to be enough. So, it will build. Where does the spot price get to as a result of rampant speculation? I don't know. can it get up to 2000 levels? Sure. Can it get above that? Sure, if the demand's there. Does that break the market? No, because ultimately what fixes the market is utilities coming to a fair and reasonable price negotiation over a long-term period to entice supply to come to market.
All right, I've got 3 more questions and we really are out of time, but I'm going to try and get through them. So if you can be relatively brief. If you could only invest in one uranium stock, what would it be and why? I love it. I love that you guys, you come out and go, just give me the easy one. Just tell me what to invest in.
Look, I got asked this the other day, and the answer is a very difficult one. But when I look at, as a mining investor, you obviously want to see your investment bring free cash flow at some stage.
Yeah.
When I look at what's going to come to market here in Australia, there's only one answer for that, and that's Boss Energy, because it's in the right jurisdiction, it's fully permitted, sunk capex, optimization studies. They went and bought some uranium that's now $10 or $20 in their favor, and utilities are taking an interest in them. So if I'm looking for an investment there that will come to market in this first cycle and eventually see some free cash flow, you sort of have to look at that one.
Yep. Okay. Next question. Let's make. What will be the single biggest driver of the uranium price over the next 5 years? Decarbonization.
Yeah, look, decarbonisation, but probably more importantly, it'll be utilities actually securing their long-term supply ahead of the next wave of demand, which will be small modular reactors.
Yep, we love those small SMRs, as they like to call them. We are out of time, Guy Keller. What a fabulous presentation. Really interesting. I love the fund and what you're doing because it just makes it easy. And the person, Craig, if you could only invest in one uranium stock, well, I guess invest in the Tribeca fund, and then it makes it easy for you. They do all the work.
Yeah, that's the answer I always want to give, but not necessarily the right one.
I did it for you, Guy. There you go. Guy Keller, thanks for joining us at the NWR Virtual Resources Series today, and look forward to seeing you again soon.
Thanks, Kerry. Lovely to chat, and thanks for having me.
Cheers, mate.